Good day, everybody. This is Brian from QuantLabsNet.com. In this video, I am going to go over a presentation I made yesterday at Moomoo Financial Canada with my meetup groups. And I just wanted to go over it for those that may have missed it. So this is the power presentation, exact same that I presented to the group, minus the questions, which were quite good actually. So this is AI power trading from analysis to automated strategy. So I've been working on this for a couple of months now. But big thanks to Moomoo for allowing our group to be hosted there. Um, so obviously, you're watching my video, so you know who I am. Just so you know that I've been running the new web domain at quantlabsnet.com, the old one at quantlabs.net. There's my contact as well. So typical industry thing that you'll get from whoever you watch on financial information that you're about to watch is knowledge, general knowledge, and for educational purposes only, should not be considered. For accurate and precise daily data calculations, consult with a financial professional or utilize specialized financial software. So also a lot of this, what I'm showing you is just the last 6+ months of research. I've been doing this. This is no way final. And the AI stuff that I show you is just that. It's AI projections. This is just right now theoretical, just to show you that I'm able to get applications to a runnable state. So I'm going to show you two. This is the latest that I've got and working. I've also got some files I show you to showcase this as well. And the whole point of this is just to get, an open criticism on if you think this works or not, like I did with yesterday. Okay, so let me just get back to where I was. There we go. Okay, so if you're new to futures and options, because what I'm focusing on, and this is futures on options, not stock on options, meaning stock options. These are outside. This is a macro, basically, not the micro. So the notional value that most people need to understand is when I define it is when you take on a futures position, you're going to have that plus the total size, which becomes your notional value, basically the contract size times the current price. So if you're really, really new, remember I have a course on this that goes over 26 days, that goes very deep on this. I can't show people how to do futures and options trading in this 20-minute, however long this video is. But basically, it's a standardized legal contract to buy or sell a specific asset like a stock index, oil, or gold at a predetermined price on a future date. The core concept means that with a future, it's an obligation, which means you have to complete the transaction. People that use these kind of contracts are by speculators to bet on a price direction that's used by producers or consumers to hedge against in a future date. With an option, which is the difference, is that this is not an obligation. You buy a call, or you buy, which is a call, you sell, which is a put, and it's an asset at a set price on or before a specific date. Core concept here is to understand that you're going to pay out for a premium. That's the only thing you pay out to enter into it, to buy an option or a set of options. This allows you to have the flexibility to walk away if you want. So there's no obligation to complete this. So you can speculate here with limited risk, protect the existing investment through hedging, and generate income. There's other ways to do protecting your existing investment, not just hedging, but building more complicated strategies through arbitrage. So as I mentioned in past videos, very recent ones, in fact, there's the three contract tiers. There's a micro contract, 1/10 the size of a full contract of the notional value. Mini contract, 1/5 to 1/2 of a full contract. Full size, which is standard, and these can get pretty big, a couple 100,000 as well. If you're a beginner, you're gonna work in the micro contracts. Also, with the options, it said, I keep pressing the wrong button here. Anyways, a couple of advantages. So if you're trading equity like in stock or ETF, the futures will give you higher capital efficiency, favorable tax treatment. That's probably in the US, maybe in the UK, but in Canada, we don't have that anymore. We're nearly, you can trade nearly 24 hours, 5 days a week, pure asset exposure. Now, the advantages of options over equity would be you have a defined limit risk, strategic flexibility, you have a cost efficient leverage, and you have income generation by selling or writing the options. Advantages of futures versus retail Forex. Now, I stress the word retail Forex. Here we have through the futures of currencies, we have centralized and regulated exchange, transparent volume data, no counterparty risk, and standardized contracts. Um, the advantages of options over retail Forex again, strictly limited risk, profit from the volatility and time. That's a key one right there because I do believe, and economists, everybody you read, it's we will enter a very severe volatile period moving forward with all the debt and all that and all the lack of clarity in the markets. Also with options, there's no obligation for buyers and you can work in a more broader market. Now, the advantage of futures over crypto, can't believe I'm saying this, but here we are, highly regulated and secure. And I only bring that up being in Ontario, Canada, when you have Binance and what they got booted out for and what happened to the founder going to jail, CZ. Um, Plus, we got simplified short selling, no wallet or custody needed, superior capital efficiency. So again, the options advantages over crypto. You have a defined risk in volatile market. That's very helpful again when it gets volatile. Regulated access, strategic sophistication, because you're going to build up more sophisticated strategies, and you have no self custody harassment or hassles. So here we're going to present the CME list. This is on the Chicago Mercantile Exchange. Obviously, this is going to be U.S. centric, all U.S. dollar. When I do my analysis with real futures data, it's 1 year. The more critical point to make this more work in a predictable way, we had one guy last night challenging on this, and he's claiming, and this is the horse and buggy people, they claim that AI does not work. So I challenged him saying, do you use option chain data? He didn't say yes. So I think you get better results if you had access to better real option chain data. And again, if you're willing to pay from, you get up to 1.5 days to 1.5 years. So the optimal to use is three months of option chain data. So yeah, this option chain data is very expensive, especially if it's like outside of stocks and just everything else that I'm about to list here. It's very expensive. So you can spend up to 1,400 per month plus a licensing fee, and you be put on a 1 year contract. One popular example is Data Bento as a supplier. So with what I'm about to show you, I create individual instrument reports in detail using the techniques in a minute once we get through this list. And there's 40 plus of those that get generated. So here we have, and this is where I generate individual reports for for all of these. So they will be the ES, which is the S&P 500. You get in the equity index as well. You get the Nasdaq, Dow Jones, and the Russell as well. Also, you get the metals. So we're talking aluminum, gold, copper, palladium, platinum, silver. We also have energy, Brent crude, crude oil, heating oil, uh, natural gas, and gasoline. We also have this long list here with agricultural product, corn, soybean, some of the more popular ones, coffee, cocoa, and so on. This is where options really shine. If you get into really bad markets, everything's not performing. One of these is usually going to perform over a long period, so that's where you can still somewhat get some performance when all other things are not working. Um, we also have the interest rates via the U.S. Treasury market, so it'd be 2 year, 5 year, 10 year, 30 year. Also with the crypto, right now I only work on the Bitcoin and Ether. Um, Plus, they just recently added Solana and XRP, so I'll start to add those two to my analysis as well. Plus, you get the currencies of Forex, Australian dollar, Canadian, Swiss franc, the dollar index itself, the euro, British pound, yen, and the New Zealand dollar. So, what I'm going to show you here is the institutional level type of analysis for both futures and options. So, this is used by a lot of the multi-billion-dollar firms out there. That's including the HFT shops, hedge funds, the banks, all the big operations, and how they do the analysis of futures and options. So here, I don't go deep in it, but what you're doing is essentially you're trying to assess the current market condition and then forecast from that point on. So the volatility assessment is where it goes deep. That's really important. Um, we look at historical volatility, price action, long-term contract context. So we are looking for the risk prospective, and that's part of the crucial aspect when it comes to pricing options. We also calculating the implied volatility. We gauge the market using various inputs into option pricing models. And then from there, we can generate various implied volatility on the put side and the call side. So you get your bullish or bearish sentiment. And this is using true data. Okay, this is very data driven. These are not mathematical hypotheses, right? So again, the more sophisticated, as I said, with the hedging, what we're doing here is we're formulating, evaluating. We are using typical statistical analysis, returns, variance, correlation, trying to calculate the optimal hedge ratio. We're trying to find how effective, if there's basis risk there, uh, the difference between cash price and the future price. And then from there, we do an overall scenario analysis, trying to establish a floor price. Um, and that protects against price declines, which still allows for potential gains. So out of that, we're getting in the options where we're getting specific analysis and strategy. Part of the other problem with this is that one guy, I don't know, we got a review saying they were expecting a full-on demonstration of all this stuff. And as I refer to people, we can't do a whole lot in 20, 30 minutes. So I always made references to where to go for that. But this guy wanted to see, um, he wanted to see everything in 20 minutes, and that's not possible, especially when you're learning from beginners that come in with zero knowledge. And this is who this presentation addresses. Anyways, so the option specific analysis, what you're doing is you're trying to evaluate do an evaluation analysis by deconstructing premium that you're going to pay out, and that's going to use intrinsic and time value. Out of that, you're going to develop all kinds of complex option strategies, and out of that, part of that, there's a huge use of payoff diagrams. Okay, so this is another important factor is when it comes to high frequency trading and the shops that do it, market making, all that, this is what they're looking for. There's arbitrage and mispricing opportunities. They use a put call parity check. I've gone over that in past videos. Also, sometimes you can see that difference between the cash and futures arbitrage with analysis to see if there are opportunities. These could last like a couple seconds, couple of minutes. That's why those firms trade on ultra low latency. All right, so some of the predictive elements I use is ARIMA. Other techniques is regression, other ones as well that you can use. Very simple ones, nothing complicated. Law firms will develop their own derivative built off of Black-Scholes. They'll have some of their own working equations that work, and some may break down under certain market conditions. Anyways, so as I said, all those individual reports I just showed you using all those techniques, they're then compiled and fed back into an AI to generate an executive summary. So I'll show you that in a minute. And what we're doing here is we're trying to gauge the overall market risk, and a lot of that's through volatility, using volatility metrics. We evaluate and construct the optimal hedging strategies using statistical analysis and scenario modeling. You'll see that in some of the individual reports. And a lot of it looks like not very great, but out of that, we allow those to be fed in and then to get a general uh, consensus from the executive summary. And again, that's all driven by AI as well. Okay, so part of the other thing we do is to dissect option positions. We do that through Greek analysis and valuation metrics to manage the risk and understand the current price behavior and the expected price behavior, or however time frame. Identify the structure and potential trading opportunities, ranging from the complex option strategies to arbitrage. Alrighty. And question is, does this stuff work? And as I said, to get where I'm at now, what I'm showing you is quite literally taking months, 6 months, 8 months since I started back that far. But the point here is on July 23rd, this being, I believe, the 30th, we look at the call back then saying, oh, RTY oil may be performing. A couple days later, you can see if you're using the ES S&P 500 as your benchmark, you can already see that the RTY and the CL are outperforming the ES. Okay, so again, that's just on the raw price, because you'll see uh, the next set of forecasts that I did yesterday is built around a bearish outlook, not just price itself. So I'm emphasizing that because what I'm about to show you is to predict an actual price decline in two assets, which I'll talk about in a minute. All right, so we come to that point. So basically, what I'm going to show you is there's two applications now that I use. I have a set of prompts now that I use, but I still will get different results from those prompts. But there's similar outlook of different outlook of or um, the in Streamlit, which is a web front end. And the two things that were identified out of this, and this was generated 2 days ago, the two that were identified as potential moneymakers using specific strategies was silver and cocoa, and that's again using the bear put strategy. So that's predicting price to come down. To get to this point, what I'm about to show you is using the LLM Claude 3.7 reasoning. I've experimented with a 4 with and without reasoning. It's very expensive to use. I'm getting the same quality output at a much cheaper rate using 3.7. So far, it's been pretty good up until last week. Um, that problem, what came up was classic hallucinating. I might be able to show you that in this application in the Streamlit, but with the new Quen 3 coder, um, there is ways to reduce the, or maybe even eliminate the hallucination. Because you can tell in the prompt saying, this is hallucinating, we're getting excessively high numbers, and the AI will recognize that and try to correct that in the coding updates within the Python code. So let me show you that right now. Okay, so you can see here in my WSL, with Windows System Linux, I have launched this application here, which is currently going to set up everything. So it's a Streamlit Run app. So you'll get that source code. So you have to set up your environment to get this running. I'm assuming you know how to do that. So here's the application. So it's setting up all the data right now. Um, and what it's going to show is I've set up the starting capital at $50,000. The expected return on the overall portfolio is, this case, 2.69. We have here some assets we can look at. But the thing that's important to take away, and all I really care in this process now, is there's a table. Where is it? Yeah, it's in the portfolio dashboard here. Okay. And remember, this is all generated by AI. Somebody did ask if I'll give away the prompts, and that's kind of like a funny question because that's my mother goose who lays the golden eggs, so don't expect that from me. I do have the source code available. Doesn't know, I don't know why I can't access that. But anyways, the idea here is to generate to look for what are the highest producing or has the highest expected returns. So in here, hopefully, okay, so let me just show you. So this is if I was to make 50,000 with all of these assets listed here, all of these with the specific strategies. Um, that's all I'm going to get. But what I did say is we have here, and I think some of them are subpar return on an expected return over the 30 days. So the one that's making the most money is this one right here, which is a cocoa. Wow, it's not even working. Yeah, I don't know. Oh, here we go. So this is cocoa with a bear put. One of the metrics we look for is the drawdown. I have no idea why this is not working. Anyways, we'll leave it at that. If you get it running, you'll get an idea. But what we're trying to do is trying to identify the assets that give us the highest expected return. So some of this stuff is irrelevant um, from my perspective. Yeah, this is it here. What I was looking for. You can see here. Here's all the different strategies with the instrument, but the one with the highest expected is going to be the cocoa bear put right here, and with the silver bear put as well, 206. So if I can get this working, so I'm not going to struggle and watch you go through that. But generally, if you can get it working, that's generally what we want. So the source code is going to be included in the GitHub repository. So let me run the other application. Okay, so wow, my computer's going crazy here. Let me just close it up here. All right, so going back to this, we have a second application, which I'll show right here. So this is the second application. So if we identify, as I said, the top returns potential silver cocoa with a bear put strategy, what we do is then we apply the trading engine. So here is what I'm going to show you here. This is all simulated data. Um, and this is it. It's only going to focus on those two instruments and pretend to trade, um, uh, but using simulated data. So this is a console app, as you can tell. We have the market overview, um, and this is all simulated in terms of pricing for both cocoa and I believe, so, yeah, cocoa and the silver. Um, so that's going to be way off in terms of the pricing. If I was to do the detail history, position details, there's nothing's been traded yet. There's the order book as well. Again, this is all simulated as well. As you can see here, here's the pricing, the bid and ask of silver. I think that, no, that's cocoa. I believe, yeah, that's cocoa and silver up here on the market overview on the order book. Then we have the historical data for today. So these are trades with all the P&L, all that fun stuff. And then you can refresh data and so on and so forth. So that's pretty well that. That's the trading engine. And again, if you look into the GitHub, you will see uh, this document I talked about, the slide, the PowerPoint right here. So it's just a PDF version. And also I've included the executive summary so you can get it. You're able to identify how I'm able to use this document and generate source code from it and turn it into a Python Streamlit application. And it can work if you have the right prompting. That's my job and my trade secret. So here you can see all the available uh, uh, instruments that were looked at. The AI will look at it and then try to calculate what strategies is best. But when you look at specifically the and cocoa and corn, no, sorry, corn and silver, you'll see in here, I'll give you very specific. So cocoa right here, a bear put spread offers explosive profit potential relative to risk. So if you were to look at that streamlet, you'll see that the volatility is very low. Max drawdowns is very low as well. But that's where it hallucinates is on that max drawdown. But generally, what I'm saying is for both the volatility is very low. I also showcase the back tested history on that. When you look at it, you see that there's still some decent performance from the last, I believe, 90 days. So here in this document, I'll say, so you get explosive profit potential relative to risk taken. Inflated option premium, meaning the cost of entering the spread with net debt debit is relatively low compared to the potential reward of if the forecast proves correct. So again, it's based upon that the price will drop, and if you get that call right, you will get, as it says, profit potential explosion. So that's for corn. Sorry, for cocoa. When you look at the analysis for silver, let's just see if I can find silver in here. Um, so, so here it does a detailed analysis on silver. So here it's saying specifically bear put spread again using the ARIMA forecast from the individual document. Clear short-term bearish trend. A debit spread is the ideal way to express this view with limited risk. Again, limited risk because it's low volatile. And then it's giving you actually detail on when to buy the strike price at 39 or 38. And then here on the profit potential, um, it's silver price falls below 38. The maximum loss is capped as the net debt paid to enter the position, making it a highly favorable risk reward setup. So basically, that means is that you pay out on your risk on the premium at 38 or $39, and if the the direction is correct, where the price does drop, you will get, as it says, highly favorable risk reward setup at low risk. So the AI identifies that, showcases that, and then when you go through that Streamlit app, you'll notice that. So that's silver. And I guess another specific advice for cocoa. Highly volatile, bear put spread, core rationale, forecast suggests a potential downturn in corn. Massive 50% volatility means that even a small move can result in substantial gains for option spreads. So you buy at 81 strike price, sell at 8,000. Profit potential has the potential for explosive return if the bearish forecast materializes, while the risk is strictly limited to the initial cost of the spread premium. And then there's the allocation. And then again, when you look at that, and then you have the source code here in the trading engine to see the strategy code for that. I haven't taken a look at it. I've shown last week code on arbitrage with, I believe it was oil. I'm not going to look at this, but yeah, I want to see people's comments and let me know in the comments section what you think of all that, because part of the problem was in last night's presentation, um, there's just not enough time to go over what's said in executive summary. So people will question that. Here, when I'm showcasing what's in the executive summary on those two very specific instruments, you can see what the AI suggests. And therefore, when you go through that conversion on the next step of the AI to convert this executive summary document PDF and turn it into code, that's where it comes out with that analysis, and you go, aha, that's what it's suggesting, and now you get the detail exactly what to do, and then you can apply that in the trading engine as well, code as well. So there's still some um, obviously tweaking, optimizing in the whole process, but generally that's how you can do it. Anyways, I'm gonna leave it at that. Thanks for watching. If you want to join my email newsletter, uh, if you want to join my newsletter, just go to quantlabsnet.com here, and if you go to the home section, what you can do is get yourself a free ebook on C++ infrastructure and how the HFT shops do it. You can get it here at quantlabsnet.com or under the Learn tab as well. Thanks for watching. Have a good day.